What do you think is going to happen in 2026 throughout the housing market?
Nobody's got a crystal ball. The point is, I'm starting to see the dogs coming. All the people that bought that shouldn't have bought, that didn't know, or joined all these groups and pooled all their money together, that bought properties that were dogs, overpriced dogs, are now stuck. Okay, because there are some
Let's do it right there.
$100,000 unit
Do that.
properties out there in Tampa. I
Stop
looked
right
at
there,
them.
Brady.
But
Yeah, so what Ben Mallah is saying is that a lot of people came down to Florida in the pandemic time and bought houses for themselves, and then a lot of people came down here from New York, and I lived down here, moved down at the early stage of the pandemic, and people started buying properties like for investment properties too when the market was really high. And now with the insurance crisis, the flood insurance crisis, the HOA crisis down here, and everybody, a lot of people have left Florida and gone back up north. Some of these properties are like almost unsellable. So he's talking about you're seeing the dogs coming to market now, and I've seen that the last year or two. You're seeing people putting stuff on the market, like duplexes and stuff on the market, and like seller finance, like low interest rate, because they have this really high price they have to get. So they're trying to like make a really sweet deal for someone to come in there and like way overpay on the price to get seller financing. So that's one thing I've seen.
So one of the things to let everybody know is there's these guys that came from New York. They sold a $1 million, $1.5 million house. It was just an average house. And they came all the way down to Florida and they see a house for $500,000, which is probably twice the size of their house already in New York. And they're like, well, we'll pay $6 now.
Let's buy 3 of them.
And that's where those houses are. They're not, you're never going to get that full value back out of them unless you continue to live there or wait another 30 years.
Yeah, and I can tell you just from personal experience living here that we have a number of neighbors on our street that bought the houses that they own without ever having stepped foot in Florida. And some of them had never even been to Florida before, like from California, from Washington State, and they bought houses sight unseen. Some of them moved into those houses and some of them are renting them out. So there was a lot of just kind of crazy stuff going on because rates were 3% and Florida real estate looked really cheap compared to where they were from. And there wasn't a whole lot of due diligence going on. This is 2021, 2022 when all that stuff was going on. So that happened. And those houses, I've seen them, some of those come back to market. The newer construction houses haven't really collapsed, at least in my area. But the stuff I'm seeing, the dogs that Ben Mallah is talking about, I'm seeing these further flung markets. Cape Coral, Florida, which was the epicenter of the 2008 real estate crash. Cape Coral doesn't have an economy at all. There's no economy in Cape Coral. There's nothing. No one has to live in Cape Coral, Florida.
Nothing driving it.
There's nothing there. There's no jobs. There's no university. There's no military base or anything. So people just live there because it's a cheap, warm place to live. And once it wasn't cheap anymore, then people don't have to live there. So you combine that with now all the hurricanes and floods that came through, and Cape Coral is a very hurricane prone area because it's all canals on the ocean. So that area is really suffering. And another area like Cape Coral is Port Charlotte, Florida, which is north of Cape Coral. Port Charlotte is a lot of canals and stuff as well in very low lying areas. And Punta Gorda right next to Port Charlotte as well. There's no economies down there. They're pretty far from airports. Punta Gorda and Port Charlotte are an hour, probably an hour and a half to Tampa. And maybe an hour and a half to Fort Myers Airport. So they're far from the airports. They're far from beaches. Cape Coral, Port Charlotte, and Punta Gorda are all almost an hour from a beach. And then there's no employers. So why are people living there? So those areas drop first. So that's what's been happening. I've seen 20% declines in values in the last year in those areas. And I think they're not done yet. I think they'll go down another 20%. So you see a lot of unfinished houses, unfinished duplexes, a lot of vacant property. I've been down to Port Charlotte quite a bit looking at properties, investor properties for sale. But the problem is that people still are thinking of these prices from 3 or 4 years ago. So they're still thinking like, well, this place was worth 500 grand 4 years ago. And it might be worth 300 grand now. And it might be worth 250 soon or 200. So that's what I'm seeing is those areas. I think Sarasota has been pretty strong. There's reasons to live in Sarasota. There's world-class beaches. There's an airport. There are employers here in Sarasota. Sarasota is also a bedroom community to Tampa, so you can commute up into Tampa for work. So Sarasota has remained stronger. It has not fallen off a cliff. But some of the condos and things are taking a beating.
Right. We kind of went into depth just on the Florida market, but I think what Jaden was trying to do is just give everybody, hey, we see this down in
Well,
Florida.
he's in Tampa. Ben Mallah in Tampa.
Okay. So
he's looking at properties in Tampa and St. Petersburg. That's what he's talking about. I live just south of Tampa, so and he's talking about he more is in multifamily commercial deals, more so than the residential stuff. So yeah, it's definitely a little different.
Is that what they're talking about? Where they're talking, everybody took a commercial loan out, they might have a 50 homes, 50 door portfolio, and they took a 5-year loan, and now that's coming to,
it's coming up for refinancing,
right?
At much higher rates.
Right. So that's where I think where people are starting to freak out because they think that was just going to stay like that. They could just do every 5 years and it's not going to be, everything's going to be okay.
Well, some of these national real estate investment companies were buying down here during COVID. A lot of them were like BlackRock, Blackstone, whatever. Invitation Homes is the big rental property company. They were buying houses down here at these high prices because they were financing them at 3 to 4% interest, and they would just buy them at like zero cash flow, assuming that, well, in 5 years they'll be worth more money than they are today, and we don't need to make any money on cash flow because they'll just go up in value. And I think it's totally flipped now. The values went down and the rates went up, so they have no cash flow. Their cash flow is actually negative now because insurance rates have gone up, taxes have gone way up, and some of their other expenses like vacancy and maintenance have gone up as well. So,
well, the demand down here is not,
and
they're not pushing the rents.
The rents have actually been falling.
We actually looked into, we were going to jump in on the rental side here in Florida, and we went to Tampa Bay. What is it? Housing?
The Housing Authority.
Yeah, and they're like, I know you guys saw these high prices, but that's not what everybody's renting out for. So we saw $4,000 rent, but now that rent's not the same anymore. Now it's $3,000.
That's from COVID. So the Section 8 vouchers were paying $4,000 or $5,000 a month back during the COVID era because the rents were really high and the demand was very high. And we went to the meeting and they were basically saying that's the vouchers are still pegged at those levels, but they're not going to pay that out because the median rents aren't that high anymore. So they're the ones that were $5,000 might be $4,000 or $3,500 now
because the demand's not there.
Yeah. So the rents have really come back down to more normal levels. So yeah, that's our take on what Ben's saying. Florida real estate is definitely correcting. It's starting in the far-flung areas and in condos. And places that are in flood areas are really taking a beating, like Punta Gorda, because the insurance costs are so high. So you pretty much you're going to get cash buyers that come in there and they just don't carry insurance. They buy cash and don't carry insurance.
It's kind of the thing now, though, is what we're hearing is they would rather just
self-insure,
put $100,000 into the house again, and hope for another 15 years nothing comes back.
The thing is, if this $700,000 house you now buy for $350,000, and you just pay cash for it, and you don't buy insurance, and if it floods, you just fix it. So that, the economics makes sense if you get a much lower price on the property.
Right.
That's what, even on the oceanfront properties, that's kind of how that's going too. But the problem with the condos is you can't self-insure condos. HOAs require insurance, and they get their own insurance, and it's very expensive. So the condo situation it's kind of a train wreck. And I just saw a condo in St. Petersburg that was listed for, I think they bought it for $750,000, and now it's listed for $250,000. And it's a nice, downtown St. Pete, nice condo building, great area, but the HOA dues are $2,000 a month. So if you buy that condo, you're buying yourself a $2,000 a month HOA payment. You're paying money for that to get that payment. And I think most people are like, that doesn't make any. Plus, that could go up. It's going to go up in the future. So you're buying a liability that's going to just keep getting worse.
Right.
So it's really hard to justify that, especially when you don't know how much worse it could get. So condos are really dangerous. They're they look cheap, but I would stay away from condos. They're just way too dangerous.
All right, Brady, roll the video.
The dogs. I got to come in and spend millions of dollars. They need roofs. I don't like the way the metering system is, or there's all kinds of issues in them. They're the gray market ones.
Mm-hmm.
Okay. The ones that might be in a flood area, all the gray market. The garbage comes first. But eventually I'm hoping the good stuff will come. Unless those rates come down, but they've really gone down a lot. They went down a little, but not much. Now if rates come down, then their values will go back up. But if rates stay the same or go up, then there's going to be some blood in the water.
We could pause
Well, it
it.
has to be.
I'm gonna pause it. So what Ben's saying is, I've seen the same thing, and now the good properties have come down in value, but you're talking about a 10% drop, not a 50% drop. So good properties in good areas that are not prone to flooding, that you can still buy insurance at good rates for. The area that I live in is like that, and prices have come down 10%. So, a place that was 800,000 is now 720. So it's a little bit better, but they're still very high. And I think that might continue on that slow kind of flat line or decline trend on the good stuff. But he's talking about interest rates, and nobody has a crystal ball, but I don't see interest rates going up. I don't foresee why they would go up unless the economy just gets crazy hot this year. But Trump has said it's a major priority to drop interest rates for him, and he's pushing Fannie Mae to buy mortgages to drop rates, and he just is nominating a Fed chair that's going to drop rates at the Fed too. So I think rates are going to be flat to down, and if they come down enough, that will actually catch this market, especially in these good areas. It will prevent these good areas from falling too much further. I think these rough areas with flood problems, the rates aren't going to matter. I really don't see why it would matter because there's so many structural issues in those areas. So that's my take on it. You have any thoughts, James?
No, I'm my biggest thing is the interest rates, like he said. Are they going to come down? Are things going to move?
I think we start getting rates down to 5.5% this year, which we could on a 30-year mortgage. I think that good areas that people want to live in that are safe and good schools and are not prone to hurricanes or natural disasters in other areas of the country, I think you're going to see a stabilization of pricing and demand. It's like Minnesota, we do a lot of Minnesota, obviously, and if you get rates at 5.5%, Minnesota's going to probably take off a little bit in some of the suburbs because you had a lot of people on the sidelines at the 6 to 6.5% interest rates. Right. And once it goes to 5.5%, it's going to be like, okay, this is like we can afford that now, and that feels like a more normal interest rate.
Which is pretty much where everything was. What, in the 2000s?
Yeah, most of the 2000s it was 5 to 6%.
Yeah,
that's pretty normal.
And we had a boom. We had all that boom stuff, and we didn't have this thing called COVID that kind of took off. Made everything else take off too. So, that was a fluke. We got to go back to our original numbers.
The 12 years of low interest rates was abnormal. My first house in 2005 was 5.75% mortgage, and I thought that was a great deal. So that was normal for a long time.
Right.
So we'll probably get back. That's where we're headed to. I think is in the 5s, and everybody will get used to it. And I don't know if it'll go back below 5 again for a long time. It probably won't.
Maybe not in our lifetime, huh?
I don't know. I don't predict that far out, but not for a while. So,
all right, Brady, continue.
Why haven't we seen all these mass sell-offs throughout commercial real estate yet? Are you noticing foreclosures? Are you seeing
because of the stock market? That's why. No. Okay, we all know what the is your problem. The cat fell on the floor.
The cat fell on the floor, and you clawed at it with your foot.
Okay, let's stop right there. Okay, so what he's talking about, he says this because of the stock market. That's probably part of it. I own some commercial properties, and so I see it from the other side of it. And what I can tell you, and I'm also a limited partner investor in a lot of commercial deals, and there's been some foreclosures. We've lost a property to foreclosure in one of the deals I invested in. So that wasn't fun. But a lot of times the banks don't want to, like on a single family house, the banks want to foreclose because they can throw it on the market and sell it. And they might make frequently more money than they even have that they're even owed on the loan. So they're highly incentivized to foreclose and get rid of that property and get paid back. On a commercial deal, there's a business operating in that property. Even apartment complexes, those are operating businesses. And if you foreclose on a building like that, that business can get destroyed in the process, and the value of that asset will decline substantially when that happens.
So it's not a good thing to do that.
Most banks are not in the business of operating properties. They're not in the business of operating businesses. And so they want to try to work with the operators as much as they can to try to get the thing stabilized. And then they might put it in a receivership to try to stabilize it and then try to do a workout or whatever. There's a lot of negotiating that goes on with these deals. And a lot of times when they eventually do have to take the property back in foreclosure, like they're going to take a bath on it frequently. They're going to lose money. They're not going to make money on that deal. So the banks are really not incentivized to take back commercial properties. They really kind of want to hold them on the books and just keep them stable as much as possible. And they're all kind of hoping that the commercial market will pick back up rates will come down, and then they can exit gracefully at some point in the future, is what they're all trying to do. So the same thing happened after 2008. Like, commercial real estate did not hit the market in waves of foreclosure like the residential market did after 08. It was workouts, rewrite loans, just make it work as long as you kick the can down the road as much as you possibly can. So that's what's happening too. But eventually that's going to stop. And we're, in 3 or 4 years into this now, and some of these banks are going, okay, it's been 4 years. We haven't been paid. We got to take this thing back. And we're going to take a huge loss on it. There's commercial properties in Minneapolis that were bought for $100 million downtown that recently traded at like $7 million, 93% drop in value. And the bank probably finances at 80 million or something, 75 million. So that's happening. And they're at the end of the rope on some of these deals. So that is starting to happen. But yep, that's all I had on that.
Cool. Keep it going, Brady.
Inside was up, and then you put it on top. You don't need a
I
cap
just
on
used
it.
my foot to push it.
You grabbed it with your toenail.
Well, I just don't want any of your germs getting in my body. My toenails are clean. I took a shower this morning, but I have been walking barefoot all around here. All right. So anyway, listen, it all because of the stock market. And you're a stock guy. Okay. All right. Let's play with Jack a little. Maybe he'll
Sure.
learn something before this is over.
I would
Right.
like that. That's the
Maybe.
goal.
Maybe he'll learn something.
We try.
All right. Basically, the value in a bank, you know what that is?
It's the debt that they have.
Exactly. It's not that stupid.
Yeah.
The bank is only worth what their loans are. The deposits. They gotta have liquidity requirements. They gotta have deposits. But the bank makes money on loaning money. So basically, the bank is only worth the loans that they gave all that money to. If the loans suck, then the bank sucks. And when the bank sucks, the stock sucks.
I spy on my competitors every day over coffee. Let me show you what I do. So I use this website, similarweb.com. They have a 7-day free.
And they don't want that to happen. They don't want to see. All right, we had a crash in 08. You know why we had the crash in 08? Because the banks gave out too much money. Can I say?
Yeah. Go for
The
it.
banks gave out too much money to people they shouldn't have. And there was a lot of crooked going on. That's what caused that crash. So they had loans that were worthless, okay, or worth pennies on a dollar. Now we're not in the same situation. The people that they loaned the money to, they weren't intentionally crooked or, poor judgment or poor loans. At the time, they made sense. The bank takes risk. The bank didn't think of the risk down the road of rates going up. They didn't hedge themselves enough. Maybe some of them did. So basically, when they loaned all that money out at 3.5%, 4%, they were saying, my home loan is 2%.
Here.
Not this house.
Oh,
no,
the
no.
other house. Oh,
2%.
interest only, right?
2%.
Yeah.
Too
Anyway.
flat.
Too flat.
But
baby.
it's interest only
It's all timing.
for how
Interest
many
only
years?
15 years.
15.
All right. So anyway, the bank's losing money on that because they
Yeah.
can take that money they gave me and reinvest it at 6, 7, 8%. The point is this, the banks are not making money on these loans now only because interest rates gone up and they underwrite a lot, at a much more higher debt ratio. You know what debt ratio is, right? How much debt you have towards your principal.
Mhm.
Anyway, long story short, if the property can't cash flow anymore or it's breaking even. See, I think what's happening is it's breaking even right now for all these people because the rates are going up. They can't refinance. If they refinance, they got to go refinance at a higher rate.
Mm-hmm.
Okay? So a lot of these fixed terms are up.
Let's
Typically
talk about that
commercial-
real quick. Yeah, so what Ben's saying, and this has been my experience in some of the deals that I've been an investor in as a passive investor, is that those deals were put together with limited or no cash flow back in the COVID era, with the assumption that rents would go up and values would go up and things would appreciate. And now, 5 years later, they're still sitting there with no cash flow, and these were at rates that were low, 4% interest rates on commercial deals or 5%. And now it's okay. So it's not cash flowing at this low rates from 5 years ago, and it's going to have to be rewritten now because it's been a lot of these commercial deals are written on 5-year terms. So after 5 years, they come up for a reset, and now the rate's going to go from 4.5 to 6.5, and it doesn't pencil out. You can't pencil it because there was already not cash flow at 4.5. So then what do you got to do? Well, you have to sell the property because somebody else is going to have to come in and recapitalize it at a 6.5% rate and maybe more equity or whatever they're going to do to fund it. And they're not going to pay the price that you owe on the mortgage. They're going to pay lower because they have to make the numbers work. So that's where we're sitting. So everybody's been trying to just kind of like delay this whole thing as long as possible until the rates came back down a little bit, which they have come down a little bit, but they're still too high for a lot of these deals. So we're starting to see the slowly things come into market and get reset. I think apartments have taken a beating, and offices for sure have taken a beating. Some of the other stuff like self-storage has not, I don't think. Mobile home parks haven't. So it just depends on the asset class, how much they've been reset on pricing.
Go ahead.
I borrow money in my world. It's 3, 5, 7, 10, depending on the asset. You pick your choice on how long you want to fix the rate for. So, sooner or later, all the people that took, whatever loans, they're going to fix rate's going to be up. They're going to have to go to the market, and they can't afford it or they might break even. They'll say, I'm not owning this big ass place for no return. If they're non-recourse loans, they'll throw the keys in. I'm starting to see that. Well, because nobody's going to make a capital call and bring the mortgage down.
Let's talk about that real quick.
So basically,
a lot of saying these are non-recourse deals. A lot of these commercial properties are bought with non-recourse debt, which means there's no personal guarantee on it. It means that usually the investors that put the deal together brought in 30% down, at least, maybe more. And because they brought so much money down, the bank doesn't require anyone to guarantee the debt personally. So what that means is if the project fails, no one's personally on the hook for it. You lose your 30% down and you walk away from it. So you have a and that's what most of these deals are written up as, like that. So if you have a non-recourse debt deal and you're not cash flowing, or maybe you're losing money on it, at some point you go, well, why are we holding this? It doesn't make any money. It takes our time. It doesn't look like it's going to make money in the near future. And now it's going to require us to send in money because it's actually like negative cash flow or needs capital improvements or whatever. And so you get to a point where they just walk away from it because there's no recourse to any of the owners or investors of the deal. So at that point you go, well, we can have the keys because we don't want to put any more money in this thing for no return. So that's starting to happen now in some of these deals.
Walk from properties, big groups that, different individuals, investors, or the bank's going to take them back because they're not making a mortgage payment. I mean, but we don't know. I mean, if rates go down or who knows, but the banks don't want you to know. Believe me, the banks are sitting on a lot of loans right now that they probably wish they didn't have.
So what's your prediction though? What do you think is going to happen over the next year? Are you bearish? Are you bullish on the market?
All I can do is tell you, I'm hoping and praying that I'll start seeing some distress in the market. I'm starting to see it trickle down. Like I said, the dogs come first. So, that's what I'm seeing. But hopefully I'm going to start seeing the stuff that's worth me buying, the good stuff.
So far, what have you had to do to sell your places? Because you're also selling into the same market that you're buying.
Apartments.
Imagine being
Is that
able to
what?
build an
Not
app with your
selling.
name on it.
We'll see what he
Just
says.
by
He
thinking
said he
about
wasn't
it.
selling.
Meet Base
I
44.
don't know why he wouldn't be selling.
I'm selling retail based on a cap rate. People buy shop and says all day long at 7 caps. If it's a good brand with good tenants, there's always guys out there that are willing to get 7% return, 7 cap, as long as, they're not borrowing too much more money above the 7 cap. Because basically, if you make it 7% on the retail center and your mortgage is 7%, then basically you just get 7% on your down payment, correct?
Mm-hmm.
Some guys are happy doing that, But right now, if you buy a 7 cap, strong guys that buy shopping centers can borrow in definitely around low 6s, if not 6.
Yeah.
So basically, they make a point spread on the bank, and they make 7% on their return on their down payment. There's always a market for that,
Yeah. So what would it take right now to see the market
And hotels
fall?
are just too much for me right now. I got too many hotels.
Yeah. What would it take for the market to fall? To
The
start
market
to see those distressed properties come up?
For the banks are going to have to say, okay, we already played the game, pray and delay. And now we got to figure out what we're going to do. We delayed. I mean, how long are we going to have loans being extended? I mean, I had some loans come due and the bank just sent me a paper saying, oh, please sign this and your loan is extended. I mean,
Really?
they don't want to with me. You know, they don't want to put the property. They don't want to go for the money. Let's just keep it the way it is so we figure out what the hell we're going to do here. I mean, it's all about
Yeah.
money and rates. You know, hopefully we'll start seeing some people can't handle today's interest rates. Plus, in Florida, we got other issues. I don't know about other states. You know, it's for a while there, insurance was killing us because of these hurricanes and all. You know, whenever there's a hurricane or a big expense insurance company's got to pay out for, what do? They come in and raise the rates and make all the new people that are getting insurance now pay them back all the money that they had to pay out in a hurricane or disaster. That's what they do.
Yeah.
Insurance companies don't lose. We're insurance. We ain't taking a loss.
And by the way, quick thanks
Let's
to our
talk about that
sponsor,
real quick.
CyberGhost.
Yeah, so Ben Mallah was just talking about insurance and commercial properties and some of these loans that are kind of just zombie loans. And insurance, I've seen insurance across apartments and hotels because I've been involved in both, like double and triple in the last 5 years. And you've got insurance is a really big part of your operating expenses in these properties. So when you have a property that's barely cash flowing or cash flow, break even, and you have a major expense that doubles in 1 year or whatever, or triples, now you're negative cash flow. And so that 7 cap that you bought or whatever it was when you bought it is going to be a 7 cap on a much lower number because you're now losing money in the insurance policy. So that's just one more factor. That's affected everybody across the entire country. Because I've got properties in Minnesota and other states that we've seen, it's not a Florida thing. It's all over the place. And I don't know, what exactly is driving that. It must be the natural disaster losses. And, we had the Tennessee, North Carolina thing that happened and all the Florida stuff that's happened. So that's a huge problem. So all this stuff's got to be rewritten with, you got to re-underwrite stuff with higher insurance costs, higher property taxes, and higher interest rates. It's all, and the rents have not gone up. So the values have to come down to justify all that. So, yep, that's what he's seeing. And I would just add that what's interesting is, with these commercial real estate mortgages, the banks are kind of partners with the owners. And so you don't see the banks come after the owners like they do in residential. In residential, they treat you like, I don't know, if you don't pay your residential mortgage, what happens? Does a bank call you and ask how they can help?
No,
Usually they don't.
no.
They send you nasty letters and tell you to pay them or else move out. That's usually that's what I think how it usually happens. And in commercial, they don't do that in commercial because they don't want you to move out. They don't want you to move out. They don't want to upset you so you damage the business in any way.
See, I learned something from you. And again, guys, I learn something from this guy every day. But I didn't realize that once you let a business like that go, even as a bank, you're damaging the business.
You're damaging your collateral.
Yeah. So it does make more sense why they want to help out. Obviously, it's a higher price too that they've already lended you. And the other thing is they don't want to damage that.
The asset being the operating business.
Yeah.
And in residential, if you stop paying them, it's almost the opposite because the longer they let you stay in the house not paying them, the higher their risk is of you damaging the property while you're living there for free. And I think we've seen that when people stop paying their mortgage or their rent, frequently go into, for whatever reason, they go into, I'm not going to take care of this place, and frequently just actually vandalize and damage the place. So it's almost the reverse. Like as soon as you stop paying your mortgage, they're like, we need to get you out as fast as possible because we don't want the place getting damaged. So, but the one thing that's changed since the 2008 crisis is that Obama and the government put in a lot of policies to make the foreclosure process on residential less harsh and less fast. They slowed it all down and they made a lot of these workout things. They used to have that HARP program, the Affordable Recovery Program, whatever, that rewrite your mortgage. And I think that still exists. So if you go into foreclosure with residential now, there's still opportunities to work out your loan or rewrite the loan. That's new, pretty new stuff that didn't exist 20 years ago.
Right. But one of the reasons they're doing that is the housing. I always tell people they don't want to foreclose on your house. But if it gets to the point where they have to because they're in the business of loaning money. They're not in the business of selling and buying houses.
Selling houses.
Yeah. And so they do want to work with you. So
as long as you can pay them.
Correct. I mean, you have to have a path. If they don't see a path where they can get caught up or you can get caught up, then they're going to.
If you can't pay them, they're going to take the house back because they can sell the house.
Right.
But a lot of that stuff is not because banks are nice. It's because the government has required them to be nicer. Is what a lot of it is. Because if you look back at the 90s, the early 2000s, that was not going on. They just foreclosed and take the property back. And in 08, when 08 first started, that's what they were doing. When it first started, they were just start the foreclosure process, take the property back as quickly as possible, as allowable by the timeline. And then the government came out and said they put a freeze on it. Like, you got to stop doing this. You got to start rewriting some of these loans, trying to work this out with people. And then even when they did foreclose on them, the government would prevent them from selling the properties on the market. That didn't happen until like 2012, 2013. And when the government started that, that's what stabilized the housing market. Was the government came out and said, stop putting foreclosures in the market for sale. You can resell them to investment groups, and then with the agreement that they will not sell them. They have to rent them out. And that happened like 2013 is really when you saw that happen. And once that happened, the market stopped falling and it started going back up again. Because what was crashing the market was all the foreclosures being dumped in the market. And as soon as they stopped it, that really the market stopped falling. So that's why I think we won't have a crash like that again, because the government won't allow any of these banks to dump properties like they were doing in 08 through 2012. They won't allow it. There's already rules in the books to prevent it.
Right.
So, and we don't see foreclosures down here. Florida being the crisis housing market you'll see in the news or whatever, like there's not any foreclosures down here. Hardly any. You don't hardly see any because the system's different now.
Well, they wanted to make it better. They had to make it
Yeah,
better.
they're trying really hard not to foreclose on people, and when they do, you're not going to see them listed for sale. They're going to do something else with them. They'll disappear somewhere into a hedge fund, or it'll go somewhere. They won't hit the market. So